Three couples walk into retirement with nearly identical portfolios, identical advisors and identical dreams, yet 10 years later one regrets waiting, one feels free, and one survivor ends up safer after claiming early. That sounds backwards, because every chart on the internet keeps repeating the same message. Delay benefits, get a bigger check, win the game. But retirement is not a game board. The shocking part is not that delayed claiming can fail. The shocking part is how often standard advice ignores the years when your body is strongest, your marriage most active, and markets most dangerous. Most people think this decision is only about extracting the highest total dollars. It is not. It is about timing income, protecting assets, and matching money to the years when money changes life most. Today I want to challenge a very popular belief without turning this into fear theater, because the goal is not to scare anyone into claiming early, and it is not to shame anyone for waiting. The goal is to build a smarter framework, one that respects health, markets, taxes, survivor needs, spending behavior, and the uncomfortable truth that none of us gets to average outcomes across 3 lifetimes. And before we get into the numbers, I want you to picture your own retirement calendar, not your advisor's spreadsheet, because the answer changes when real life enters the room with uncertainty. My name is Dave. If you enjoy practical retirement math without the sales pitch, tap like, subscribe, and answer this. What would you protect first in retirement, monthly lifestyle, portfolio balance, or future survivor income? Here is the hidden mistake behind most claiming conversations. They compare one benefit amount to another benefit amount, but they do not compare the entire retirement system that sits around those checks. Social Security is not a stock account with your name on it that compounds untouched while you wait. It behaves more like longevity insurance, a paycheck designed to reduce the risk of outliving savings. Once you see it as insurance, the question changes immediately. You stop asking, how do I win the most dollars from the system, and start asking, when should I activate protection? That shift matters, because maximizing a monthly check and maximizing retirement outcomes are not always the same thing. In fact, for many households, those goals point in different directions. A larger check at 70 can be mathematically attractive and still be strategically weak if getting there forces heavy withdrawals during a bad market, taxes you poorly, or costs healthy years. This is where blanket advice starts breaking apart. Blanket advice assumes your health, portfolio, marriage, spending behavior, and sequence of returns look like everybody else. They do not. And when the assumptions are wrong, the recommendation can still sound sophisticated because it uses clean charts, break-even ages, and polished language that feels objective even when it is incomplete. Let us start with break-even math, because this is where people get emotionally trapped. Bigger checks later must be better, right? Not necessarily, because time and investment opportunity matter. The standard break-even chart often treats $1 at 62 like $1 at 90. That is convenient for simple explanations, but it is not how money works in real retirement. $1 received earlier can be invested, can reduce withdrawals, can pay bills during a downturn, can fund tax planning, or can preserve shares that would otherwise be sold at terrible prices. So the fair question is not just when delayed checks catch up in raw dollars. The fair question is when they catch up after considering what earlier cash flow allowed you to avoid. Even a modest return assumption changes the picture dramatically. If early benefits help you preserve portfolio assets growing at 4%, the break-even point can move much later. At 5% later still, at 6% later again. Suddenly the so-called obvious decision becomes a longevity bet, and many retirees do not realize they are making that bet. That does not mean claiming at 62 is automatically correct. It means the decision is conditional. And anyone presenting one universal age is selling certainty where uncertainty clearly exists. Now add real life expectancy. Average outcomes matter, but averages do not pay your bills. Half of people die before the midpoint in a distribution, and nobody knows which side they occupy. This is the emotional blind spot in retirement planning. People will debate decimal points in return assumptions, then ignore mortality variability like it is impolite to mention the obvious. If you delay for the bigger check, you are betting you live long enough to enjoy the payoff. That can be a rational bet, but it is still a bet. And if you lose that bet, The cost is not only unclaimed benefits, the cost may include years of extra work, more portfolio stress, postponed travel, or deferred experiences you cannot recreate. This is where healthspan becomes more useful than lifespan. Lifespan tells you how long you might be alive. Healthspan tells you how long money can still buy mobility, adventure, and energy. A few $1,000s in your early retirement years can fund flights, family memories, and physically demanding experiences. The same dollars later may fund comfort, care, and support. Both uses are valuable. I am not pretending late life spending does not matter. I am saying the value of money changes with your body, your energy, and your options. That is why retirement planning cannot be reduced to maximizing checks. Retirement is about converting accumulated capital into lived experience, and the conversion rate is not constant across age. If all advice focused on was total dollars collected, then maybe delay would dominate more often. But retirees do not live inside spreadsheets. They live inside bodies, marriages, and markets. And markets, especially early markets, can wreck beautiful plans. This brings us to sequence of returns risk, the boring phrase that quietly destroys more retirements than most people expect. Sequence risk means the order of returns matters. A bad market in the first years of retirement hurts more than the same bad market later, especially when withdrawals are high. Imagine your spending target is stable, but your guaranteed income is delayed. During those gap years, your portfolio becomes your paycheck, your shock absorber, and your emergency backup all at once. If the market drops while you are pulling heavily, you are selling more shares at depressed prices. Those shares do not participate in the rebound because they are already gone. This is not abstract theory. Retirees who hit rough markets early know the feeling. The account drops, withdrawals continue, and suddenly every decision feels like damage control, not planning. Claiming earlier can reduce that pressure. It may not maximize your monthly benefit, but it can reduce forced selling during the most fragile years of retirement, which protects future flexibility. That trade-off is often undervalued because the headline number is so persuasive. Bigger check at 70 sounds like strength. Lower withdrawals at 62 sound boring. Boring can win. Sometimes the smaller benefit today improves the larger retirement system tomorrow by preserving capital, reducing panic, and buying time for markets to recover. That is strategic, not emotional. And strategy matters more than ideology here. There is no medal for delaying. There is no medal for claiming early. There is only the outcome your household has to live. Now let us talk about psychology, because retirees are not robots, and no spreadsheet can force confident spending. The source of income changes behavior more than many planners admit. Many people feel comfortable spending guaranteed income because it arrives predictably and does not shrink the account they watch every week. Portfolio withdrawals, even planned ones, feel like erosion. So what happens? They underspend. They postpone joy. They protect balances they never intended to leave untouched. Then they age, slow down, and finally realize they saved for a life they delayed living. Early Social Security can change that permission structure. It can create an income floor that feels safe to spend, which helps retirees actually use the plan they built. That behavioral benefit will never show up perfectly in a break-even chart, but it is real. The best retirement strategy is not the one that looks best on paper. It is the one you can execute consistently without fear, second-guessing, or constant regret. Sustainable behavior beats theoretical optimization when the plan must survive decades of uncertainty. I have seen households with strong balances agonize over small experiences because every withdrawal feels like a loss. Then a guaranteed check arrives and suddenly they start saying yes again. The math did not change overnight. Their emotional relationship to spending changed. That matters because retirement is not won by dying with the highest account balance and the fewest memories. Now let us make this more useful for couples, because married households should not treat claiming as two isolated decisions. It is usually one coordinated system across 2 lifetimes. The key rule is simple and powerful. When one spouse dies, the survivor generally keeps the higher benefit and loses the lower one. That changes everything about strategy. If one spouse earned much more, maximizing that higher earner benefit can protect the survivor later. At the same time, the lower earner can sometimes claim earlier to create cash flow now. That combination can reduce portfolio strain in the early years, support lifestyle spending, and still preserve a strong survivor benefit later. It is not impatience. It is coordination. This is why generic advice fails couples. A chart comparing one person claiming at different ages does not capture survivor dynamics, household cash flow, or how losses feel after a death. A coordinated plan asks different questions. Who is likely to outlive whom? Which benefit will matter most to the survivor? How much bridge income reduces withdrawals before larger benefits begin? That is a far better framework than simply repeating wait for the biggest check. Bigger for whom and at what cost are the questions that actually matter. Let me walk through a practical pattern many couples use. The lower earner claims earlier, creating immediate monthly income. The higher earner delays, building the future survivor benefit. During those years, portfolio withdrawals can be lower than they would be if both delayed. That may improve portfolio longevity, especially if markets are rough early in retirement. Later, when the higher earner benefit begins, the household may have stronger guaranteed income and a less damaged portfolio. If the higher earner dies first, the survivor keeps that larger check. Notice what happened. The couple did not maximize every check immediately, and they did not delay everything either. They used timing as a lever to manage multiple risks. That is the core message of this video. Claiming age is not a morality test. It is a risk management decision with trade-offs across longevity, markets, lifestyle, and survivor protection. Now let us address a major objection. What if you are healthy, your parents lived long lives, and you fully expect to live into your 90s? Great, that matters. Long life expectancy absolutely strengthens the case for delaying, especially for the higher earner in a couple. But it still does not erase sequence risk or cash flow stress during gap years. You can be healthy and still retire into a terrible market. You can be healthy and still panic when withdrawals spike. You can be healthy and still value earlier flexibility. That is why a good decision is layered. Longevity assumptions matter, but they should be considered alongside portfolio mechanics, withdrawal rates, taxes, and your actual willingness to spend from investments. Speaking of taxes, timing Social Security can create planning opportunities people overlook. Early retirement years before full benefits, pensions, or required distributions stack up can be valuable tax windows. Some households use those years for Roth conversions, while taxable income is lower. Others coordinate withdrawals to avoid bracket spikes later when multiple income streams turn on simultaneously. This is not a tax tutorial today, but the point is important. Claiming decisions affect more than benefits. They shape the tax map across your retirement timeline. Another overlooked point, flexibility. Claiming early is often described like a permanent mistake, but real life offers more nuance than the internet usually admits in simple headlines. Depending on your age and timing rules, some people can suspend benefits at full retirement age and earn delayed credits later. That can create adjustments if circumstances improve. Maybe you claimed early because cash flow was tight, then later inherited money, returned to work, or sold a business. The strategy can evolve instead of remaining frozen forever. That flexibility matters because retirement rarely unfolds exactly as modeled. Health changes, family needs change, markets change, and sometimes the best decision is the one that preserves options. Let me be very clear here. I'm not saying everyone should claim at 62. I am saying 62 can be a deliberate, intelligent move. For some households, waiting is still absolutely the better choice, especially if they have strong health expectations, ample bridge assets, low sequence risk exposure, and a clear survivor strategy. For others, early claiming can reduce fragility, improve confidence, and unlock better overall outcomes, even if the monthly benefit is smaller. Smaller check does not always mean smaller life. The danger is not choosing one age over another. The danger is adopting a rule because it sounds smart without testing whether it fits your personal retirement system. So how do you make this practical without becoming a full-time spreadsheet warrior? Start with a simple framework and build from there, one layer at a time. First, run a break-even analysis using a realistic discount rate, not zero. Use at least a modest rate to reflect what earlier cash flow can preserve or earn. Second, Model your portfolio withdrawals under multiple claiming ages, especially the first 10 years. Focus on how much you would withdraw if markets were weak early. Third, if you are married, model survivor income explicitly. Do not stop at household income while both spouses are alive. Test what happens after one benefit disappears. Fourth, evaluate your spending psychology honestly. Are you comfortable drawing from investments, or do you freeze when balances fall? Fifth, map your health span goals. What experiences matter most in your 60s and early 70s? Your claiming decision should support the life you want to fund. If that sounds like more work than a catchy rule, it is. But retirement is one of the biggest financial decisions of your life, and simple slogans can be expensive. Here is a mindset shift that helps. Instead of asking, what is the best claiming age, ask, what risk am I reducing by choosing this age? If delaying reduces longevity risk in a way your plan truly needs, excellent. If claiming early reduces sequence risk and improves spending confidence when your plan needs that, excellent. This removes the ego from the decision. You are not trying to prove you are mathematically superior. You are trying to build a retirement that remains stable under stress. And stress testing matters more than best-case optimization. Plans fail in bad years, not in average years. Your claiming strategy should help you survive bad sequences, not just pretty scenarios. Think about the first decade of retirement as the launch phase. Every decision made there has leverage. Income timing, withdrawals, taxes, and market conditions interact more than most retirees expect. A strategy that looks slightly less efficient on paper can outperform in real life if it reduces mistakes, panic selling, and chronic underspending during that launch phase. That is why many retirees who claim earlier do not feel like they made a mistake even when someone shows them a chart with a larger delayed check. They are measuring a different outcome: less stress, more flexibility, better travel years, fewer forced withdrawals, more confidence for the surviving spouse. Those are not imaginary returns. And yes, some people who delay will be thrilled they did. If they live long, planned well, and protected the gap years, that strategy can pay off beautifully. The point is not to replace one rigid rule with another rigid rule. The point is to stop pretending. There is one answer for everyone in every retirement. Your decision should reflect your health, your assets, your relationship, your taxes, your behavior, and your priorities. That is not complicated because planners need jobs. It is complicated because life is. If a planner or commentator gives you an answer in under 30 seconds without asking about withdrawals, spouse benefits, health and spending behavior, they are giving you a headline, not advice. You do not need perfect predictions to make a strong decision. You need a framework that respects uncertainty and a plan that does not collapse when reality shows up early. So if you have been hearing, always wait until 70, translate that sentence in your mind. It really means, this may be optimal under a specific set of assumptions. Your job is to test whether those assumptions are yours. If they are, wait proudly. If they are not, do not force your life to fit someone else's chart. Retirement is not a contest to collect the largest theoretical number from one line item. And sometimes that means turning on income earlier, protecting the portfolio, and spending your strongest years with intention instead of postponing life for a check you may barely use. If this conversation challenged the way you have been thinking, good. That means you are moving from slogans to strategy, which is exactly where retirement decisions get better. In the comments, tell me your situation in broad terms: single or married, early retirement or still working, and what matters most right now: cash flow, survivor protection, or maximizing later income.